Welcome to this class on the topic of sources of finance. First, let's pose the obvious question. Why does a business need finance? Well, when we look at this, it takes us into many areas associated with different types of finance and the type of the organization and so on. So we need to methodically work our way through the various aspects of the business and the type of business and the type of finance that's appropriate for specific types of business. In fact, what we're going to do in this class is to do this in a very general form, to give an overview of the sources of finance. Well, there are two compelling reasons as to why a business may need finance. First of all, we have new businesses. They require finance for equipment, materials and premises and so on. All of the expenditure that's necessary to bring a business into existence. An existing business also has a problem that it may need finance for expansion, for investment, or for increased stock holding, or perhaps to expand the markets, more marketing in a particular area, perhaps overseas. So existing businesses have a need for finance as well as new businesses. In most cases also, production takes place in advance of receipts. So production and all of its associated expenditure takes place in one time period, and perhaps in the next time period, when the goods are sold, the receipts from those sales flow into the business. And there's a gap there, a gap between production and receipts. And that means there is a gap to be filled, and finance has to be found to fill that period between the two. And this is a cash flow issue that that needs to be taken into account by the business. So some of the finance may come from the entrepreneur's savings. When the entrepreneur sets up the business, they may have enough resources to finance the business. Depends obviously on the size of the business, on what it's going to produce, and on all of the cost structure of the business. It also depends, of course, on how rich the entrepreneur is at the start. However, when savings are insufficient, as they usually are, the entrepreneur may have to seek finance from external sources. Now, the external sources, these may take two forms. First of all, borrowing from an institution, such as a bank. Well, that's the most obvious one. When we want to borrow money, we go to the bank. There's a second one, where we could invite investors into the business, and they take a stake in the business. Now, obviously, this depends on the legal form of the business, the legal structure, or what sort of legal implications are involved for the investors. With a limited company, for example, it may be possible to take in investors and give them a share of the company, in which case they are entitled to a share of the profits, and they are also have a say in the management and the running of the business. Not everybody perhaps would want that, but it is a possibility. And we also have to recognize that the finance would vary, generally speaking, would vary over the life cycle of the business. Obviously, the need for finance is more pressing at the early stages. As the business grows, it may be able to rely on its own resources. But we need to look at the phase in which the business is operating. And the life cycle of businesses can be viewed under various headings. For example, with the startup stage. Now, the startup, the pure startup, the original moment of startup is in the mind of the entrepreneur. That means nothing happens, it's just in a planning stage. But in the early phases of the startup, it starts with a plan, it starts with an idea, and then it develops into something more concrete, perhaps real expenditure on machinery, on premises, on offices, or whatever. So that's at the very starting phase. The second phase of the business is the growth phase. It's where the business is starting to expand, perhaps also looking internationally, and it's developing new products and new markets. The consolidation phase is where the company is fighting to maintain its market share, and it's attempting to establish a reputable presence in the market, a reputable presence in the community, perhaps, or perhaps within the business community. So it's trying to consolidate itself. It's trying to establish itself as one of the reputable players in the business world. The maturity stage is where the business has become established and the management structure is well tried and tested, and perhaps the business is engaging in research and development and is developing a reputation for innovative projects. So it's mature. It's an established business working on developing new lines of production, new products, innovating products, projecting itself in the market. Then unfortunately we have the decline stage. The business becomes inflexible, its management becomes dated, and it starts to miss market trends, it doesn't keep up, it'll lose market share, and eventually either it will close down or it'll modify itself. It will regenerate, perhaps hive off parts of the business that were not working effectively, or perhaps focus in on some aspect that has more growth potential. But certainly the business as was will have changed totally. Clarification of the various sources of finance. Well, we can group these under various headings. For example, debt finance and equity finance. We'll have a word about those in a moment. Then we have external and internal sources of finance, and we also have the sources of finance that may be classified according to the repayment period. Now, the debt and equity finance, well, there are two types here. One is debt. Go to the bank, borrow the money, repay the money, plus a rate of interest. The bank must make a profit, so the rate of interest is the bank's gross profit. So debt finance involves a rate of interest and an obligation to repay. Equity finance, by way of contrast, is when investors are invited to come into the business, bear some of the risk of the business, share the profits, have a say in the management of the business. But the money that the investors put in is not repaid. It's gone into the business. It stays in the business. There's no repayment and there's no rate of interest. But part of the ownership of the business has been sold. Now, external and internal sources of finance. External sources of finance include banks and institutions that lend to business, venture capitalists or whoever. This form of business usually entails a rate of interest and is secured on the assets of the business. Depending on the nature of the contract or depending on how the money is lent, there may be a legal agreement that a certain proportion of the profits have to be returned, or a rate of interest, as I said, even though it's not a bank, but some return on the amount put in would be agreed by the business. Of course, if the business doesn't honour this, then there will be legal implications. Internally generated funds usually involve retained profits. So a business makes profit in a certain time period. It doesn't distribute all of the profits. It keeps some back, and this forms its internal funds for investment or to see it over a bad time. Internal finance has the advantage that it does not include borrowing at a rate of interest. However, it's only available, of course, to profitable businesses. Not everybody can have it. Well, the less successful businesses can't have it. Now, sources of finance may be classified according to the repayment period. Well, in respect of the time period, we can imagine there have been 4 types. We never repaid. Hard to believe. Long-term finance, medium-term finance, and short-term finance. Well, the never one. Share capital may never be redeemed. If you put money into a business and buy ordinary shares, you may never get your money back. There's no time period associated with the repayment of owner's equity. You put money in, it stays in. Other forms of timeless finance include retained profits. That's money that perhaps could have gone to the shareholders, but it's not. And also the provision of depreciation. That's timeless. It's just money set aside to replenish or refurbish the premises or buy new machines or whatever. So the provision of depreciation in the accounts, keeping money aside for depreciation, is very similar to retained profits. Long-term finance, typically around 10 years. I mean, it's not a precise definition, but it's roughly speaking about 10 years. This may take the form of a mortgage on the premises. You may go to the bank and borrow the money and pledge the premises or pledge some assets of the business in return for the money borrowed. Debentures are a special type of borrowing in this context. They're like loans. They involve a rate of interest and a redemption date. And they're issued in the form of bonds and secured against the assets of the business. By that I mean, if the business wants to raise money, it can issue these bonds, which is really a repayment date plus a rate of interest. And it's guaranteed, the bond is guaranteed by the assets of the business. That's what a debenture is. In the medium term, that's usually between 2 to 10 years. Again, rough time periods. It may take several forms, such as a bank loan, a hire purchase, or a lease agreement. Hire purchase, you buy it and you pay for it as you use it, or a lease agreement where you don't actually own the machine, or you don't own the car, or you just lease it. You get to use it and you pay in return. So medium-term finance can be of those forms. Short-term, usually up to about 2 years. Again, 2 years, well, yeah, okay, 2 years. This type of finance may take various forms. We could have overdrafts. These are very expensive. You go to the bank and you have an overdraft, it's expensive. You pay a high rate of interest. But in the short term, it might be the best way to do it. Trade credit, you perhaps receive the goods, raw materials perhaps from your suppliers, and you negotiate not to pay them for an extra time period. Or there's something called factoring. This means you have debts, or you have money perhaps due to you. Let's consider it this way. You have money due to you from the sale of goods. It hasn't arrived. You can sell the money that's due to you. You can sell the obligation that people have to pay you to a factoring business, they will buy it at a discount and they will collect the money on your behalf. Of course, you receive the money from the factoring business straight away, and they receive the money that would have gone to you in the future, and the difference is their rate of interest, what they've charged for doing it. So factoring is a way of getting short-term finance. We can summarize a lot of this in a very simple diagram. Not a very adequate diagram, but nonetheless, have a look at it. Here we have, I'll just put the cursor on the screen. Here we go. Here we have sources of finance going into the business. We have receipts from sales going into the business. And then we have output expenses, wages, machinery, so on. We have dividends going to the shareholders. We have interest going out. We have many other factors going out, many other classifications of expenditure going out, which mostly appear in the profit and loss account. We also have discretionary payments out of the profits. We could have payments to charities and so on. So we have a whole list of items coming out, and we have some items coming in. That's a very inadequate diagram in that sense, but it just gives a feeling for the way the thing works. We have cash flowing in and we have cash flowing out. Now, let's look at debt and equity contrasted. Well, when shares are used as a means of raising finance, then both a share of future profits and a share of control of the business is given up, is forfeited. So using shares, this is the equity part, when using shares to raise money, the business gives up part of its ownership. The people invest in the business, they become shareholders. They hold ordinary shares so they can vote and they can say how the business should be run, or what profit should be retained, and so on. And shareholders who have 51% of the business or more get to control the business. The owner must balance the need for finance against the loss of future profits and greater interference in the management of the business. So although you need the money, or although the businessman needs the money, or the businesswoman needs the money, they must balance the loss of power, the loss of ownership. Now, there are two approaches to the management of a business. Well, we have the proprietor. This is the person, or this approach sees the owner as attempting to be self-reliant. This is the the small business person, the proprietor. Any expansion is usually financed out of his or her own pocket. They, generally speaking, do not like to go for equity finance. Second, the entrepreneur. These are keen to expand. Entrepreneurial businesses are keen to expand, keen to do things, to innovate, to export, and so on. And they're always in the market for money. Or generally speaking, in the market for money. They like to raise cash to expand their plans. Now, let's look at a table that contrasts debt and equity a bit more clearly. Right, now down the left-hand side, I'll put the cursor back on the screen. Down the left-hand side here, we have finance from share capital. It's the black box with the white writing. Now, the owners of the shares own the business, and the shareholders may vote and determine the direction of the business. Dividends are paid out of the net earnings of the business. After all of the expenditures have been subtracted, all the necessary expenditures have been subtracted, leaving us the profits, the net earnings, dividends are paid out of those. So, finance from share capital, owners of the business, the owners of the shares own the business, and the shareholders may vote and determine the direction of the business. That's essentially the equity bit. Now, over here on the white part with the black writing, finance from loan capital. Well, a loan represents a debt and does not confer ownership. It's just a debt. The business is a legal entity. As a legal entity, it can borrow money. And it borrows money, it owes the bank. The bank does not own the business. The business simply owes the bank the amount it borrowed. Creditors have no direct say in the management of the business. They may influence the business by making conditions associated with the loans, but they have no direct say. So the bank may say, well, I'll lend you the money, but you must do the following if you want the money. That's a condition, but they don't have a direct say. They don't get involved in the business. The interest on a loan is a business expense and must be paid before the dividends are paid out. The loan may be secured against specific assets. It may be that you borrow the money and say it's guaranteed by the premises. Not by the machines or by the office equipment, but just by the premises perhaps. Or it's guaranteed in whatever way. And finally, the interest on a loan is tax deductible. Now, finance from share capital. Well, the board of directors of the business determines the level of the dividend paid out. That's what the board of directors does. There's no obligation to pay a dividend other than the morale of the shareholders. So the business doesn't have to pay a dividend. It may refuse to pay a dividend. However, if the shareholders are dissatisfied, they may sell their shares, which will drive down the share price, which means the business is not valued as much as it was before, and it may be taken over by some other investors who perhaps are more aggressive. When people buy shares, there's no maturity date. You don't get your money back in the future. You simply put the money in and take a share of the business, take a degree of risk in the business. They're not redeemable at some future date. Finance from loan capital over here. Well, the business has no discretion over the amount of interest payable on a loan. It doesn't. It negotiates the loan, but it's take it or leave it. If the bank says the rate of interest is such, that's it. If the interest is not paid, then the bank or the creditors may call for the liquidation of the business, closing down the business, selling off the assets and getting back whatever they can out of the money they have lent. Loans must be repaid. Failure to pay interest and capital according to an agreed loan may lead to liquidation. It may lead to the business closing down. Loans increase the risk for the business. Quite a bit to think about in terms of the difference between finance from share capital and finance from loan capital. Very important distinction. Finally, businesses with high proportion of finance in the form of loans are said to be highly geared. This is a technical term, highly geared. So if a business has a high proportion of its finance in the form of loans, they are highly geared. Lots of loans on the balance sheet. There are advantages to high gearing. The stakeholders have access to more finance and therefore may engage in expansion and have more entrepreneurial projects. The ownership of the business remains unchanged as more finance is raised from loans. So there's no equity finance, there's no new investors coming in, it's simply the banks or the lending institutions giving more money if they think the business is a good risk. The interest on the loan, I beg your pardon. The interest on the loan is an expense for tax purposes. On the other hand, dividends are paid out after the tax has been paid. So, There are advantages to high gearing. There are, unfortunately, disadvantages. As mentioned earlier, loans must be repaid, and this increases the possibility of company failure. A loan must be repaid. It's an obligation. And if the company fails, it'll have an effect on the trade creditors, on the suppliers of raw materials, or people who have performed services for the business may not get their money if the business fails. The shareholders will lose the money they put in the form of investment at the start, and of course employees will lose their jobs. The terms and conditions of loans may restrict the use of the assets. This inflexibility may ultimately work against the business. It could be the terms of the loan given to the business by, say, a bank restricts it from doing certain things. If the business wants the loan, it may have to agree with the bank or agree with the lending institution that it will or it will not do certain things. The impact of high gearing is to reduce dividends as a proportion of sales. This means that any fluctuation in sales revenue will have an amplified effect on dividends. The first call on profits will be the lending institution, the bank. The loan gets priority. It must be repaid and the interest must be paid. So that is fixed. Highly geared businesses may find it difficult to raise further loan finance. If you already borrowed a lot of money, perhaps banks and other lending institutions are not prepared to talk to you about lending you even more. So if things got pretty bad in the future and you really did need an extra loan, it may not be there because you've already borrowed so much. So highly geared businesses will experience problems such as those just listed. The management, in its desire to raise further finance, will therefore be mindful of the balance between equity and debt finance that should be struck when raising additional finance. There are two ways to go: borrow from investors through equity, or borrow from the banks or lending institutions. And each have pros and cons which must be balanced. Now the term structure of debt finance, well, I mentioned earlier there are bonds called debentures that companies may issue. These are bonds that can be traded. They can be bought and sold by anyone after they've been issued. There's no ownership conferred in the form of these bonds. You don't get to own the business. You just simply have an obligation on the part of the business to meet the terms of the debenture, pay a certain rate of interest and redeem it at a certain future date. The amount that the bond trades for from the nominal price, that's the price stated on the bond, may vary. This may vary according to what people believe about the business. Will the business honour its debts? Will it go into liquidation? Will it make big profits next year? So the actual traded prices of the debentures, like any bonds in the market, will vary according to the perceptions that investors have about the business. Debentures may be secured against specific assets of the business, or may be drawn as a charge against all the assets of the business. So you may issue a debenture on the premises, not on the furniture, not on the machines, just on the premises. Or you may issue the debenture on the machines, not the premises, nothing else, just the machinery. So it depends. The debentures could be issued on the whole business, on some part of the business. It's simply a bond that promises to be paid back at some specified future date and to yield a rate of interest. If, of course, by the way, if the bank rate of interest increases more than the debenture rate, then of course the price of the debenture will fall. You've got to think about that one, but there is a relationship between the bank rate of interest and the debenture rate of interest. Next is mortgages. Well, these are long-term loans, usually against land and buildings, and it could be 30 years, 20 years, 25 years, whatever. Long-term. Mortgages are generally available from banks, and they usually have restrictions, usually requiring the business to maintain a certain amount of liquidity, a certain amount of cash to meet the mortgage obligations. Medium-term debt. Well, this type of finance covers a period up to 2 to 10 years. Medium-term finance may convert short-term debt into medium-term debt. Companies who have short-term debt, sometimes they don't want to repay it, or perhaps they want to use the resources for some other project. They don't want to repay the short-term debt, so they may be able to negotiate a longer time period, so it becomes medium-term. Examples, for example, an overdraft and exceptional trade credit may be consolidated into a medium-term loan. It's quite common. There are 3 types of medium-term debt: loans from banks, hire purchase, you get to use a resource and pay for it over a certain period of time. Obviously there's an extra expense in doing this because you don't have to pay for the product, the machine or whatever it is up front. You don't have to pay for the whole thing, you just pay a certain proportion in every time period. Lease finance, well, you don't actually get to own the machine at all. At the end of the period, it reverts back to the original owner. You get to use it. It's leased. Leasing arrangements have advantages for the business. The business doesn't have to find a deposit. You just lease it. You just sign a leasing agreement. The business doesn't have to account for depreciation or maintenance or obsolescence. So having got the machine leased, then the onus is on the owners of the machine to keep it running, to maintain it, to make sure it doesn't go obsolete, and at the end it'll have depreciated considerably. That's the problem of the people who leased it. And of course, leasing payments are tax deductible. The disadvantages of lease finance: well, the business is committed to a flow of outgoing according to the contract. So the outgoings are contractual, they have to be met. The total cost of the asset may exceed the purchase price, more than likely, because, as I said earlier, there is depreciation, obsolescence and so on that's met by the owner who has leased the machine or leased the asset. The terms of the lease may restrict the use of the asset. So when first leased, the contract that was issued at the time of the lease may specify how the asset is to be used, how the machine perhaps is going to be used, or in what way it's going to be used, or where it should be stored or kept, or whatever. So there may be restrictions on its use. And finally, of course, the business will never own the asset. At the end, it flows back to the business that leased it in the first place. Further disadvantages of lease finance: well, A related form of finance involves leaseback. This means that the business may sell an asset and then lease it back. It may sound a bit strange, but it's a way of raising finance. It may be possible, for example, to sell the premises, sell the business premises, and then lease them back, rent them back in effect. So the business receives the money from the sale of the asset and then pays a smaller proportion as rent, so that in the short term at least there is more cash flow in the business. Obviously there's no long-term asset, so the business is worth less. Short-term finance. Well, short-term finance is required to bridge the gap between the purchase of inputs and the receipt of the revenue from the sale. Short-term, it's a gap. When businesses are established, these two ideally should be synchronized. They should almost be on top of each other. They should coincide. But they seldom do. The product is made in one time period and the receipts come in the next time period. And there is a gap. So there may be changes in the trading environment which can cause this, changes in custom and practice in the business, in that particular business. So for whatever reason, short-term finance is important to again ensure that the business has got adequate cash flow. There are several forms of short-term finance available. Overdraft, well, very expensive. It's just simply designed to bridge a short period of time. Very flexible and for an agreed time period. Very high rate of interest, generally speaking. They're not secured, generally speaking. They're just an overdraft. The business gets one. It's not issued. The overdraft's not issued against specific assets. Overdraft facilities may be secured by pledging some form of return in the event of failure, but that's generally speaking not the done thing. But it is possible. They may be permanently in place. Some businesses run with permanent overdrafts. They seem to like having the facility, so they keep it running. Interest charges on overdrafts, as I said, can be quite extensive, can be quite high, and it's certainly much higher than a loan. Trade credit. Well, this means borrowing from your suppliers. In other words, you receive raw materials and you don't pay for a month or 2 months or 90 days or whatever it is. There's some agreement that the goods arrive now and it will be paid for in some future time. This gives you a chance to make the item and try and sell it, get the revenue from the sales and pay for the raw materials. It's also the case that, of course, creditors may give discounts and that sort of thing on their sales to you, on the sales to the business. So, summary of the sources of finance. Increased gearing has problems, increased borrowing has problems. Control of the business depends on the type of business, type of finance, I should say. The business needs to calculate the loan servicing implications, make sure it can meet the obligations. And raising additional sources of finance will have implications for the resources left for dividend distribution. Presumably the investors who put money in at the start, the equity investors, did so to get a profit. And if that's been sapped up by interest payments, I should say, well, that means profits are reduced. Factors. Well, a business requires revenue from its sales before the agreed time extended to its creditors, then it may use the service of a factor. A factor buys the trade credit at a discount and collects the cash in the due period. That's it. They buy the trade credit at a discount and then they collect the cash in the due period. The factor makes a profit and the business receives the payment early. That may ease, of course, cash flow problems. Various sources of finance should be matched to the need. There are various sources available, but it depends on the need. Is it long-term, short-term? What is it? The purchase of land and other long-term assets should be financed by long-term sources of finance. Sounds right. Overdrafts and trade credit should be short-term because they're more expensive. Failure to match the sources of finance to the requirements is both inefficient and dangerous. Right, that concludes this talk on sources of finance. Thank you for watching.